Interesting note from Morgan Stanley on the entire India material space. Most of the steel players, what they have done is they've gone ahead and maintained a positive stance. They've increased the target prices for most of the companies. Tata Steel maintained an overweight stance, increased the target price from 690 to 840. JSPL, they've increased the target price from 300 to 340. SAIL, they've maintained their equal weight stance, but they've increased the target price from 43 to 66. JSW Steel, what they've done is they've increased the target price from 320 to 410. Now, what is the reason, according to Morgan Stanley, why they've maintained such a positive stance as for most of the steel makers? According to Morgan Stanley's global team, they view macro conditions as supportive for mining as well as metal equities. They believe that easy returns have been made in 2020. However, they still think 2021 will be a year of outperformance. They expect tight supply-demand dynamics, rising input costs, and strong deleveraging to actually help drive alpha generation in 2021. They believe that the V-shaped global economic recovery and reflation trade will most likely continue in 2021 as well. In fact, their global macro team expects a global synchronous recovery to start in the second quarter of FY21, along with the return of inflation, as well as they expect the weak dollar trade is something that will continue. In this backdrop of a weak dollar, the return of inflation, they believe all of this sets up a very favorable environment as far as commodities are concerned. So on the back of that, they believe that it could be another good year for Indian steel equities. They believe the macro climate is favorable and valuations, that is the price to book, is still below long-term averages. They've identified three key themes for the Indian companies to actually go ahead and outperform. Number one is they expect the supply tightness to prevail. In the view of disruption of iron ore production and limited new capacity addition, they expect crude steel supply tightness to prevail through 2Q to FY21. They believe that a favorable outlook for international steel prices is again something that bodes well as far as the domestic pricing outlook in the near term is concerned. On the other hand, what they are saying, number two, the point is that they believe iron ore supply constraints position the integrated players with captive mines much better than others. So what they are saying is that Tata Steel and SAIL, both of whom actually have captive mines, are actually be insulated, and they believe JSPL will be partly insulated. So discount to international prices could actually narrow as far as iron ore is concerned because of rising imports. And on this particular development, they believe Tata Steel and SAIL will be the one that will benefit the most. Third point is that they are expecting deleveraging as well as balance sheet repair for the steel companies. They believe leverage ratios should fall more sharply. They believe Tata Steel as well as JSPL will deleverage the most, with potential for further upside in case any asset divestment goes through. On the back of all of this, they've gone ahead and updated their target prices and increased their favorable outlook for Indian steel companies.